Hello and welcome to Chapter 10, Understanding Financial Statements. I think this is probably one of the most important chapters for an entrepreneur, and I will demonstrate that as we go along. But we will be talking about the income statement. And to me, the income statement is the most important financial statement for a small business owner. And I'll explain that as we go along. But what are financial statements? Basically, there are three primary types. There is the income statement, the balance sheet, and the cash flow statement. And all these reports help determine what the financial performance of the firm has, or the company or the business has been, what type of resources are going to be required, and they really wrap up what, from a financial standpoint, how the business is doing and if it's actually being successful or not. And so you may find this kind of confusing, but some people find it hard to determine whether or not their business is successful. And I'm going to give you a really quick example. I was in my store one day and an old fella came in and he was looking for a lift chair, I believe. And we were talking, but he said, I had a business in this very location about 15 years ago. And I was surprised. And I said, really, what was it? And he goes, well, I actually made eyeglasses. And I was the only eyeglass maker in town before, all the big shops came and so forth. And this was a long time ago. I haven't had my business for 6 years, and so this would have been 20 some years ago. And I go, wow. And I said, how long were you here? And he said, oh, I was here for years. But he goes, I found out when I closed the business and I retired that I only survived. The business was not very successful. He said, and I had no idea over all those years, I thought that this business was booming, but it was really only providing me with current income. And of course, he had no business background. And it was kind of sad to think that, and most small business owners, they don't have masters or PhDs in business. Some of them only just have, graduated from high school and went out on their own. And some of them are very successful, but some of them just live day to day. And I think we're finding that very evident in today's economy when you look at the pandemic, where the economy was only shut down for a brief period, 4 to 6 weeks. Some businesses could not survive. They basically survived week to week, and shutting them down for 6 weeks has caused so many businesses. And some of these businesses are very large. They're just not small businesses. And I heard yesterday where one of the president's cabinet members say that they will not shut down the economy again because it was so hurtful in so many ways. Yes, it may have prevented some people from getting the virus, but in other ways, it was even more hurtful. So I thought that was interesting. As I mentioned before, there's three basic financial statements: the income statement, balance sheet, and cash flow statement. And bankers and potential investors want to see either actual or estimated financial statements in a business plan. But of course, as you know, for this course, we're not creating a business plan in its entirety. But if we were, I usually only ask my students to produce an estimated income statement because, as I mentioned at the very beginning, that is the financial statement that I think is the most beneficial for the entrepreneur. And I'll demonstrate that in a minute. So what is the income statement? Well, basically the income statement looks at profit or loss over a time period. Usually it's a month or a quarter or a year. When I was in business, I produced a monthly income statement. to help me make general business decisions on how the business was doing and how I could improve it. For those of you that have had accounting 1 or 2, accounting 1 and 2, I'm sorry, you wouldn't have had 2 if you wouldn't have had 1. You probably recognize this equation. The equation for the income statement is sales minus expenses equals profits. It's not quite as simple as that, but we will dive into it more intensely here in a second. So revenue from sales, either from the product or the service that you sell, minus the cost of producing those products or services, or cost of goods sold, less the operating expenses, the monthly operating expenses for a business, less the interest that you might pay for the money that you borrowed, or the credit cards that you have balances outstanding, and tax payments. That gives you a net profit, or an income, what you bring home at the end of the day or at the end of the month. So the income statement can give us a lot of detail on how the business is doing. And if it's not doing well, it can give us a lot of detail on why. So from an owner's perspective, for a day-to-day or monthly business analysis standpoint, I feel that the income statement is by far the most useful financial statement that you're going to use. And in my classes, I concentrate solely on the income statement. You'll go over the balance sheet and cash flow statement in accounting, but for small business management, and if I wouldn't have run a business for several years, I might not be able to say this, but having run businesses, I can tell you, and people they can disagree, but I have the proof that the income statement is the most important. It's the most useful statement. We already talked about the revenue. Cost of goods sold is what we pay for the inventory, or what we pay for the raw materials to make the product. Okay, so it's the cost of actually producing. So if I opened up a sporting goods store, I'd have to buy my footballs and basketballs and baseballs and all the sporting equipment that I sold. I'd have to buy that from a wholesaler or from a manufacturer. The price that I paid for that would be the cost of goods sold. When you deduct that from the sales, that gives you your gross profit. Some people may even say net sales, but gross profit. So that's sales less cost of goods sold. Then you have your operating expenses. And this is everything that you spend on a monthly basis related to the business. So it could be the gas bill, the water bill, what you pay for advertising, salaries, benefits that you pay for your employees, insurance every month that you pay, everything that you pay on a monthly basis to keep the business up and running and to keep it going. Now, don't mistake operating expenses with startup expenses, and we'll talk about that in a minute. So after you deduct your operating expenses, then you have your operating income, or your earnings before interest and taxes. Interest, obviously, some businesses will borrow money, or they will charge on credit card, and they will have to pay interest either on their outstanding balances or on their loans. So we're able to deduct that from the profit. Obviously, it's going to be less money that we take home because that interest has to be paid. And then that gives us our profit before taxes. And then after we deduct taxes, we have our net profit. So what is an operating expense and what isn't an operating expense? So I want to clarify what the difference between a startup expense and an operating expense. Every entrepreneur who starts a business is going to have to lay out a lump sum of money, whatever it is, to get the business up and running. So when I opened up my store, I actually had to buy inventory. I actually had to buy shelving units. I had to buy a cash register. I had to buy point of sale software. I had to buy computers. I had to buy a desk. I had to buy a chair. I had to buy shelving for the walls. I had to buy pegs to hang things on the walls. All of these things were startup expenses. They weren't operating expenses. All these things had to be purchased and spent to get the doors open. Now, an operating expense would be something that you have monthly, whereas the gas bill, the water bill, the cable bill, electric bill, salaries, and I went through that a minute ago. So be able to distinguish between an operating expense and a startup expense. They're not the same thing. And a lot of entrepreneurs, when they're figuring their income statement to put in their business plan, they don't think so much about how much it's going to cost them to start the business up. And that's one of the reasons why a lot of businesses will fail, is because they have the entrepreneur has failed to figure out exactly what it's going to cost to get up and running. So here's an overview of everything that I've just said. Gives you a really good graphic of the income statement. Sales less cost of goods sold equals gross profit less operating expense equals earnings before interest and taxes. Less interest, profit before taxes, less income tax equals net profits. And this is just an example of a company named Hauser and Associates, just as an example with some real numbers. So when you're, as a business owner, and I mentioned that I feel this is by far the most useful financial statement. Here's where it is really, here's where it's useful. So you have this income statement that has the revenue, cost of goods sold, operating expenses, your interest and taxes. And you think of what does the business owner have control of? Do they have control of revenue? Well, what are some things you can do to increase revenue? You could advertise more, which is going to increase sales, hopefully, but it's also going to increase to some extent your operating expenses, because advertising is not free, unless you find ways on social media, because that's a very lucrative way to advertise, because it's not as expensive and sometimes free. But the owner can do things when they look at this income statement. They can say, oh my gosh, month one, our revenue wasn't high enough. I need to do something to increase that. Cost of goods sold was too high because that decreased my gross profit. Maybe they were paying too much for their inventory. Maybe they need to go back to their vendors or their manufacturers and say, listen, I need a lower price. That'll decrease cost of goods sold. Or maybe they can buy in bulk and get a discount. Gross profit is gross profit. It's nothing that the owner can do or have control over. It's simply revenue minus cost of goods sold. Obviously, you want to maximize gross profit. You also want to maximize earnings before interest and taxes, which means the only thing that an owner can do is minimize operating expenses. So what are some of the things you can do there? Well, obviously, you can limit your advertising, but that's going to have a negative effect on revenue. You may be able to cut hours. Maybe you cut your store hours, which means you don't have as much salary to pay and as much benefits to pay. Maybe you eliminate some type of expense that you find that you're spending money on every month, whatever the case may be. But the point is, dissecting this income statement, we can look at the categories, and there's certain things that owners can do. Now, interest, there's not much we can do with interest other than not charging as much on credit cards, or paying credit card balances off as we charge them and not having a monthly balance. Therefore, we don't pay any interest. So there's, to some extent, you can decrease your interest. And earnings before taxes is just simply EBIT minus the interest. And taxes, well, that's just taxes. There's not much we can do there. But if we have an accountant, we may ask them if there's something we can do to minimize taxes. Taxes are pretty much static. There's not too much that we can do. But there may be some loopholes or some types of credits we might be able to get. And again, that's why it's always advisable to have an accountant, or to hire an accountant to work with you. So one of the things that I used the income statement for was to determine whether or not I wanted to go into business. And that's probably why I used the income statement. Here's what I did. And this is why I sort of have I have a liking for the income statement. Before I opened my business, before I quit my job, before I did anything, I made up estimated income statements. But what I did is I started and used it backwards. And so it was what I call a reverse income statement. So net profit is what the entrepreneur will bring home. It's the money in their pocket at the end of the month. And I knew as head of a household, a son in college, a daughter about to go into college, I knew the net profit that I needed to bring home from this business. So I would play around with an income statement by starting at the bottom and let's just say I put $10,000 net profit for 1 month. I would work backwards to find out what level of sales I would need in order to get $10,000 in net profit. And I broke it down daily. So net profit, $10,000 for the month. And we were open, let's say 24 days during the month. I would take that income statement, break it down daily, and say, okay, what is the sales or revenue amount that I need every day to get to this net profit? And I broke it down, and what I found out was, or what I assumed was, I can do this. This business can make, and I don't remember what the number was. I want to say, let's just say theoretically it was $5,000 a day. And I thought to myself, what items could I sell to make $5,000 a day, or $3,000 a day, or whatever it was. It's been a long time, so I don't remember. And so I used this backwards or reverse income statement to determine whether or not I thought the business was feasible. And I put that in my business plan. And when I had people look over the business plan, they seen that and they go, wow, yeah, it seems like you should be able to do that on a daily basis. And from, I don't know, month 2 or month 3, we were able to do that. And that's why the business, I believe that running that income statement analysis before I even did anything with the business was what made the business, one of the things that was key to the success of the business. Okay, so the income statement measured a period of time. And like I said, it's either a month or a quarter or a year. The balance sheet looks at the assets, liabilities, and owner's equity at a point in time. So as of December 31st, this is total assets equal debt plus owner's equity, whatever those numbers may be. But total assets equals debt plus owner's equity is the balance sheet equation. And the balance sheet equation, again, is taken at a point in time, not a period of time, a point in time. So if you had a balance sheet in your business plan, let's say it was just an estimated balance sheet at the end of the first year, you could show your assets, how much debt you would have, and how much owner's equity or how much equity you had in the business. Again, I don't spend a lot of time on the balance sheet because I would leave that up to the accountant to take care of. You would provide the information, but I would leave that to the accountant. And the balance sheet would be something you would probably look at on an annual basis, whereas the income statement would be something you would definitely want to look at on a monthly basis. So here's just more examples. I'm going to give you, there's a couple examples of the balance sheet here, but this gives you an overview of the balance sheet. What current assets are, the working capital cycle and how it works, and where the cash comes from in the business. Fixed assets, depreciable assets, gross fixed assets, accumulated depreciation. And again, I think all of you or most of you have had accounting, so this is probably just a review for you. I don't spend a lot of time on the balance sheet, but I do want you to know what it measures or what it looks at, what its equation is. And you can pause this and review as you want. As again, it's a point in time. Okay, it's a point in time. Taking a look at the assets of the debt and the owner's equity. Cash flow statements look at the cash flows of the operation and where they come from. Where's the cash flowing? And a lot of times this is a big problem for entrepreneurs is the fact that they don't know where their cash is coming from. A lot of times they'll have too much cash tied up in accounts payable or accounts receivable. And so that can become a problem. I'm definitely not going to get into accrual basis accounting versus cash basis accounting. You don't have to worry about that. But understand what cash flow accomplishes. So when we're looking at the financial performance of a firm, obviously we have to be able to pay our debt as it comes due. So when bills come in, we have to be able to pay them. And a lot of that has to do with the profitability of the assets that we sell. How profitable is our inventory? How profitable is our manufacturing process? The amount of debt that we're using. Are we using too much? Are we paying too much of our debt in cash and not using credit? And the rate of return. What type of return are we getting on the money that we've invested? So all these things are important when you're looking at the financial performance of the firm. However, going back to the importance of the income statement, if you can control the income statement in a way that you are maximizing your gross profit and your EBIT and your net profit, what you're bringing home, all of this will fall in line. This just takes a look at one of the ratios that is return on assets, which is very important for investors and banks to look at. They want to see the return on assets that you're getting. And again, you'd look at this on an annual basis, but a new business would look at projections, and they would estimate what those returns are. And there's some key terms. I don't get too much into ratios. Again, that's an accounting. You'll be taking an accounting, or if you haven't already, and a finance subject. So all of you will be taking financial management. But keep in mind, it's used in small business. A good business owner will know what their ratios are. But I can guarantee you that 99% of current small business owners don't even know what ratios are, let alone what their ratio numbers are for their particular business. But you will have the advantage because you will have learned it here at school, and you will know that, especially if you're looking to invest, if you're looking for investors, or you're looking for a bank to loan you money, they are going to look at those ratios. And we will talk about those ratios later, but not in this chapter. Okay, I hope all is going well. I hope you're staying safe and healthy. And I'm getting ready to go on vacation. I don't know when you'll be looking at this, but I'm getting ready to go on vacation. When I get back, I'll continue the videos, and we'll be on chapter 11. Take care and have a great day.